Hello students, your faculty for the subject of Management Accounting. Today we will be studying into the Introduction to Management Accounting. Before that, let us make a quick recap of what you have studied and understood till now about the Management Accounting subject in unit number 1, that is Introduction to Accounting. In first unit, you have been introduced about accounting concepts, its meaning, accounting conventions, accounting assumptions, process of accounting, which covers journal, ledger, subsidiary books, trial balance and final account, including trading, profit and loss account, balance sheet, and uses of computers in accounting, its meaning, role, terms, tally packages in accounting, recent trends in management accounting. Now we come to unit number 2, which as mentioned in beginning covers Introduction to Management Accounting. In our study, we shall be dividing this perspective broadly as follows: concept, meaning of management accounting, scope of management accounting and limitations of management accounting, functions of finance manager, distinction between financial accounting and cost accounting, and management accounting. Introduction. Accounting serves the purpose of providing financial information relating to the activities of a business. As we learnt that once upon a time every person was happy as wants were limited, but as wants have increased, every person tried to adjust the resources available for him. In the beginning, commodities were exchanged for commodities, but later on there was evolution of money and commodities were exchanged for money. Activities involving money increased, overall development took place and business activities have also increased along with it, and it was very difficult for any business person to remember all the transactions of the day. So there was a need to record all business happenings in a systematic way, and this job of recording of transaction has been later on called as bookkeeping. Accounting is as old as money itself. Since in early ages commercial activities were based on barter system, record keeping was not a necessity. The Industrial Revolution of 19th century along with rapid rise in population paved a way for the development of commercial activities, mass production and credit terms. Thus, recording of business transaction has become an important feature. In recent years, with the changes in technologies and marketing along with stiff competition, accounting system has undergone a remarkable changes. Now we will discuss on need and importance of accounting. When a person starts a business, whether large or small, his main aim is to earn profit. He receives money from certain sources like sale of goods, interest on bank deposits, etc. He has to spend money on a certain items like purchase of goods, salary, rent, etc. These activities take place during the normal course of his business. He would naturally be anxious at the year end to know the progress of his business. Business transactions are numerous that it is not possible to recall his memory as to how the money had been earned and spent. At the same time, if he had noted down his incomes and expenditures, he can readily get the required information. Hence, the details of business transactions have to be recorded in a clear and systematic manner to get answers easily and accurately. For the following questions at any time he likes. Question 1. What has happened to his investment? Question 2. What is the result of the business transactions? Question 3. What are the earnings and expenses? Question 4. How much time is receivable from the customers to whom goods have been sold on credit? Question 5. Like how much amount is payable to suppliers on account of credit purchase? Then question next. How are the nature and value of asset possessed by the business concern? Next, what are the nature and value of liabilities of business concern? These are the several questions are answered with the help of accounting. The need for recording business transactions in a clear and systematic manner is a basis which gives rise to bookkeeping. Bookkeeping is such a system by which business transactions are recorded systematically in a set of accounting. It is recording of business transactions in the books of accounts. Bookkeeping is a process of recording business transaction in the books of accounts in a very systematic manner. Bookkeeping is that art of recording business dealings in a set of books. Bookkeeping is a scientific method of recording the day-to-day business transactions in word and figures in the books of accounts so as to show correctly and clearly the financial position of the business. All transactions are recorded date-wise. A person who records the same is called as an accountant, who has the business results from such records at the end of financial year, which ends on 31st March every year. In India, this system of bookkeeping was in operation from 23rd centuries ago at the time of Chandragupta Maurya. Chanakya was recording the accounting transactions. He wrote a famous book known as Arthashastra. After some years, this system was called as Desi Nama. In certain parts of our country, the double entry system of bookkeeping was originated. In Italy, developed by Luca di Borgo Pacioli in the year 1494. Bookkeeping is an art of recording day-to-day transactions in the books of account in the systematic manner. Bookkeeping is that branch of knowledge which tell us how to keep a record of business transactions. It is often routine and clerical in nature. It is important to note that only those transactions related to business which can be expressed in terms of money are recorded. The activities of bookkeeping include recording in the journal, posting to the ledger and balancing of accounts. Bookkeeping provides the basis for accounting and it is complementary to the accounting process. Accounting begins where bookkeeping ends. Accountancy includes accounting and bookkeeping. The term bookkeeping, accounting and accountancy are used synonymously. This relationship can be easily understood with the help of following diagram. In this diagram, it is shown that bookkeeping is a very small part, accounting is a bigger than bookkeeping, and accountancy is a having combination of bookkeeping as well as of this accounting. Now we will see the branches of accounting. There are three branches of accounting: financial accounting, cost accounting and management accounting. Financial accounting covers accounting process, that is journal, ledger, trial balance and balance sheet. Cost sheet, then costing methods, costing techniques are part of cost accounting. And in case of management accounting, it is concerned with ratio analysis, budget and budgetary control, fund flow statement and cash flow statement, etc. Now we will see about financial accounting. Financial accounting is the original form of accounting. It is mainly conformed to the presentation of financial statements for the use of outsiders like creditors, banks and financial institutions. It is the process of identifying, measuring, recording, classifying, summarizing, analyzing, interpreting, communicating the financial transactions and the events through the financial statements. The purpose of this branch of accounting is to keep systematic record to ascertain financial performance and financial position and to communicate the accounting information to the interested parties. The financial statements, that is profit and loss account and the balance sheet, show the manner in which operations of business have been carried out during a specified period. This is all about financial accounting. Second branch of accounting is a cost accounting. Cost accounting is a process of accounting and controlling the cost of product, operations or functions. The purpose of this branch of accounting is to ascertain the cost, to control the cost and to communicate the information for decision making. Third branch of accounting is a management accounting. It is an accounting for the management, that is accounting which provides necessary information to the top level management for discharging its function. Management accounting covers various areas such as cost accounting, budgetary control, inventory control, statistical methods, internal auditing, etc. The purpose of this branch of accounting is to supply all information that management may need in taking decisions and to evaluate the impact of its decisions and actions. So this is, in this first part we have seen about what is the concept of accounting, what you learned into the first chapter, bookkeeping, accounting, and what are the branches of accounting. So this part we have discussed in this first part. Students, in this first session we have discussed about review of your first unit, Introduction to Accounting, which covered accounting concepts, bookkeeping concept, accountancy concept, need and importance of accountancy, branches of accounting as financial accounting, cost accounting and management accounting. Thank you.